Hello and welcome to the Daily Brief by Zerodha. Here we cut through the noise and bring to you the most important stories that move the markets. I'm your host Anurag Bansal. Today we'll be talking about 6 interesting stories. First, what the Indian stock market bull run means for us investors. Second, angel tax is going away. We'll talk about what it means for us. Third, we'll talk about SME IPOs and their unreal growth. Fourth, we'll discuss Bajaj's CNG plans in a world full of EVs. Fifth, we look at what SEBI chief has to say regarding mischief in the markets. And sixth, finally, we'll talk about the unemployment problem of TCS. Look, the Indian markets are at an all-time high and all kinds of stocks have been going up. It is a market where no matter how hard you try, it seems almost impossible to lose money. The sentiment around the market is also extremely bullish. Foreign investors have never been so attracted to India, and the same goes with domestic investors as well. This can be seen from the fact that domestic fund flows and FPI flows have been very strong. If you look at the markets from the bottom of the COVID lows, the Nifty 50 large cap index is up about 180%. The Nifty Mid Cap 150 index is up by about 370% and the Nifty Small Cap 250 index is up by about 470%. Now with a few minor bumps, the markets have gone up in almost a straight line. With all of this has given rise to concerns about market valuations and whether we are in a bubble. Now while talking about valuations, you should know two important things. First, just because market valuations are high, it does not mean that there has to be a crash. In fact, markets are in an overvalued zone most of the times. Second, timing the markets based on valuation is close to impossible. But why am I telling you all of this? See, Kenneth Andrande, who is the CIO of Old Bridge Capital Management, is a market veteran with over 30 years of experience. He has pretty much seen the entire journey of the Indian markets. A few days ago, he gave an interview to NDTV Profit and it was really interesting. Broadly speaking, he said that both the Indian economy and the Indian markets are in a good place. But let me quote a few things that really stood out. He said, if you're looking for value in this marketplace, my simple recommendation is don't, because it doesn't exist. So it's a market where you will have to align with businesses where you think growth is there. He also said, I'm fairly bullish as far as the economic conditions are concerned and as far as where profitability is. I might be a little circumspect, on the other hand, how to generate returns from this point. Now, Mr. Andrande is not the only market veteran who has voiced concerns about valuations. Mr. Sanjeev Prasad, who is the Managing Director of Institutional Equities, has also been voicing concerns about the overvaluation of the Indian markets. He wrote a note debunking the myths about why the bull market is raging. Let me summarize it for you quickly. He said, first, strong Indian GDP growth is not the reason why markets have been going up. In fact, there is no correlation between GDP growth and market performance. On a side note, there is a lot of evidence of this in the global content as well. As surprising and as counterintuitive as it may sound, the markets can go up even if economic growth is weak. Second, the headline valuations of the Nifty index may look reasonable, but they are misleading. If you look deeper, most segments of the market are trading at full or extreme valuations. Third, Indian investors believe that equities are predestined to deliver strong earnings growth for a long period of time. But Mr. Prasad says, and I quote, investors may want to remember several high-flying sectors that have crashed and burnt in the past, including two of the current market favorites, which are electric utilities and real estate. Fourth, markets are going up because of strong flows from mutual funds and FPIs. Now, well, as intuitive as this may sound, it is not accurate. See, flows follow price and narrative and not the other way around. Also, flows have no predictive value, which means you cannot time the market segments based on flows. In another old note, he said, it seems the market is happy to overpay for weak business models and superficial narratives without due consideration to fundamentals, risks, and valuations. Among the larger sectors, the financial sector is the only exception with most stocks trading at reasonable valuations. Now, if this sounds Greek and Latin to you, let me explain what this means to you as an investor. Well, there is an iron law in the markets. If the starting valuations are high, the future expected returns are almost always less. Today, very few segments of the Indian market are reasonably valued. So you might want to tone down your future return expectations and think again before assuming that the markets will go to the moon. It's probably always a good idea to make adjustments to your savings by keeping in mind that there is a probability that future returns may be low. Now moving on to the next story, let's talk about angel tax going away. The good news for startups is that angel tax might be going away very soon. But let me explain what on earth an angel tax is first. See, imagine a businessman who has some undisclosed income, or black money in other words. He wants to convert this into legitimate funds, so he creates a shell company and issues shares at inflated values. His friend Mr. X invests in these overvalued shares using the businessman's black money. This makes the money appear legitimate as if it were a real investment. Now, to counter these practices, the government introduced something called an angel tax in 2012. Angel tax is basically charged when a company receives an investment at a value that is higher than its fair market valuation. Not the entire amount, but only the excess amount is taxed as the income for the company. Now, this is no small tax, it is a massive 30%. See, the idea of introducing this tax initially was to stop money laundering and tax evasion. But what has happened is that it has now started to affect genuine startups. How, you may ask? Look, startups often receive investments at a valuation that is higher than their current market value. Their investments are usually based on future potential. Now, in the eyes of law, these valuations are inflated and hence end up attracting a 30% angel tax. This effectively means fewer funds for startups to grow and make an impact in the country. Now, another problem is that tax distracts founders from building quality products or solutions. It forces them to learn the nuances of the Income Tax Act. Now, don't get me wrong, of course it is important to learn about taxes. But when you're building a company, it's not something you'd ideally want to be sitting and focusing on, right? Now, talking about angel tax, Mr. Sanjeev Bikhchandani, who is the founder of InfoEdge, said, and I quote, "We are hoping that the angel tax gets eased out. We are hoping that there is some sort of incentive for investors to invest in VC funds and startups because we need domestic venture capital industry, domestic investments into startups, and risk capital to get a fillip." In a previous episode, I had mentioned about the former CEO of Niti Aayog saying something very similar. He pointed out that currently around 75% of the funds that Indian startups raise are from foreign investors, and that needs to change soon if we want to grow as a nation. Now, the good news is that the removal of this tax is being strongly considered. Recently, the Ministry of Commerce recommended to the Finance Ministry to remove it. Mr. R.K. Singh, who is the Secretary of DPIIT or the Department for Promotion of Industry and Internal Trade, said, and I quote, "Based on consultations with startups, we have recommended the removal of angel tax. The decision is to be taken by the Ministry of Finance. We have provided our inputs. It was not raised during the pre-budget consultations." In the previous episode, I also discussed how, with the rise of interest rates globally, VC investments in India have fallen sharply and they have only slowly started to recover this year. So while things like angel tax might have had good intentions initially, they are actually now hurting the startup ecosystem at a time when India needs more and more startups to solve domestic problems. If the angel tax goes away, the startup ecosystem of India will definitely get a big boost. But the concern of black money will return again, and it will be really interesting to see how this matter will be tackled. Now, moving on to the next story for the day, we'll be talking about the massive growth that the SME sector has seen. See, given the raging bull markets, currently the IPO markets have been red hot as well. So if you are the CEO of a company and you want to raise money through an IPO, you will probably have a relatively easier time doing it. And therefore, it is no surprise that funds raised from IPOs have been at record highs. Last year, companies raised 36,000 crores and the year before that, they ended up raising 86,000 crore rupees. In this, SMEs or small and medium enterprises have raised 4686 and 3095 crores in the last 2 years. Now, SMEs, as the name already indicates, are small companies and hence the IPO sizes also tend to be a little smaller. Yet, retail investors have been really attracted to them. If you look at the chart of the SME IPO, it looks like that of Bitcoin. It is up 5,000% or more in the last 5 odd years. Now, SME stocks and IPOs have fewer regulatory requirements than regular IPOs as well. This was meant to make it easier for smaller companies to raise capital, but instead, it led to massive frauds and scam in the SME segment. In March this year, SEBI chairperson raised concerns about the price manipulation in SME IPOs, and she was right. In the last year or so, the SEBI has found multiple cases of SME stocks that faked financials and engaged in illegal practices to pump and dump the IPO issue prices. Now, if you zoom out a little bit, there have been several fraudulent SME companies after listing as well. Light regulations attract fraudulent actors, and that has been the case with SME stocks. Now, since these IPOs were like lottery tickets, they attracted retail attention because they had spectacular listing gains. In order to reduce the speculation and volatility in SME IPO listings, NSE recently imposed a 90% cap on the listing price above the issue price in the pre-open session. This means a 100 rupee stock at IPO cannot list at more than 190 rupees. By the way, BSE already has this limit in place, so NSE is just adjusting the price basis of it. Now that's pretty much all about SMEs for today. Now let's talk about the next story, which is around Bajaj's CNG plans. Bajaj, which is one of the largest automobile manufacturing companies in India, has now launched the world's first commercially available CNG motorbike. This motorcycle will start at 95,000 rupees. But how does this change things for you? Well, first is that CNG is significantly cheaper and also delivers better mileage than petrol. According to estimates, costs for regular motorcyclists will come down by as much as 65%. Second is that CNG is a relatively cleaner fuel. It also has higher auto ignition temperature and a narrow flammability range. In simpler words, it is basically safer than other forms of fuel. Now, even the government has been heavily pushing for the adoption of CNG. India has been adding CNG station and piped natural gas or PNG connections at a very fast pace. Recently, the oil minister Hardeep Puri said that India is set to have around 17,500 CNG stations and 120 million PNG or piped natural gas connections by 2030. Now back to Bajaj, Mr. Rakesh Sharma, who is an executive director of the company, said, and I quote, "Today, 60% of the three-wheelers are based on CNG. And the reason for this is that compared to diesel, the operating economics for a driver are extremely beneficial. The payback for our CNG three-wheeler is 6 to 9 months time. So it's a win-win. It is a win for the driver. It is also a win for the country because it is using the network and its pollutant price is less. And it is also a win for Bajaj Auto because we've got 85% market share of CNG. He went on and also compared CNG vehicles to electric vehicles. He said, and I quote, "Compared to CNG three-wheelers, the proposition for an electric three-wheeler is diluted. But of course, when you compare electric three-wheelers to diesel or to petrol, there is a very compelling reason to shift. But not so when it comes to CNG. The requirement of a motorcycle to travel longer distances and not be bothered about charging and all of that are far simpler when it comes to CNG. So we get the question, then why not a CNG motorcycle? And therefore, we are working on a CNG motorcycle." By the way, in a time when practically all talk and excitement is around EVs, CNG vehicles have been quietly showing some promising growth. To give you some context, CNG vehicle sales jumped by 38% to 1 million units in the previous fiscal year. So all in all, it is super interesting to see Bajaj going against the conventional EV tailwinds and betting heavily on its strength, which is CNGs. Now moving on to the next story for the day. Recently, SEBI chairperson brought a very interesting topic while addressing a conference of portfolio managers. She said that trust is the foundation of market growth, and if anyone breaks it, the entire system is practically at a risk of collapsing like a pack of cards. She also said that the industry and SEBI share the same goal of putting the investor at the center. Therefore, she advised market participants to help the SEBI detect misconduct or mischief before these problems become too big and forceful regulations are needed. Now, why the SEBI chief said this is a little important to know. Look, over the years, instances of financial misconduct, fraud, etc. have become really common. SEBI has already cracked down on finfluencers that missell, and they are now looking to eliminate all kinds of malpractices and misconducts from the markets. During her speech, the SEBI chief acknowledged that they may have lesser context about the industry than the people who are within the industry. She said, and I quote, "The industry players know better than others what mischief is going on, and so the industry must report instances so that the regulator can take early action." In a nutshell, she said that it's very frustrating for good players to see the bad ones gaining market share by doing mischievous activities. Hence, the good ones should report it to the regulator so timely action can be taken. On to the last story for the day, we'll talk about what the unemployment problem of India really looks like today. Remember in the previous episode, I had discussed about how unemployment rates are falling in India, especially in the IT sector among people with lesser amount of work experience? Well, there seems to be some new and interesting news on that now. TCS, which is one of India's largest employers, seems to be struggling to fill 80,000 job vacancies. Now, India has a fairly high unemployment rate, and young Indians make up over 80% of the country's unemployed population. So, this problem is definitely not because TCS is not getting enough applications. The real problem is a lack of skills. In fact, it isn't even exclusive to applicants but also to current employees of the company. According to Amar, who is a senior employee at TCS, there is a mismatch between the skills that the employees currently have and the kind of roles that are in demand today. A big reason for this could be that the technology around us is changing and upgrading at an unmatched speed, and employees are just not able to keep up to pace. Stating this very reason, companies like TCS, Wipro, Infosys, etc. have been delaying joining dates of over 10,000 freshers over the last 2 odd years. But now there is another side to the story as well. Look, it is commonly known that the TCSs, Infosys, and Wipros of the world aren't the most handsome salary payers. People claim that this employee shortage is not really because of a shortage of skill, but it is because good talent is not really ready to work at extremely low salaries that these companies are offering. For your context, TCS, Wipro, and Infosys still hire a large number of employees at a mere salary of 3 to 4 lakhs per annum. And this is surely not the salary a qualified and skilled IT professional would aspire to take home. A user on X or Twitter went on to the extent of saying that a delivery executive in Bangalore would probably earn more money than a TCS employee. Another one compared it with the recent telecom price hikes and said that Jio and Airtel have hiked their prices by up to 25%, but TCS still gives less than 1% hike to its skilled employees. Another Twitter user who claims to be an ex-recruiter at TCS said that even for senior roles, they set budgets that are similar to what a junior engineer would get according to the market. Now, who's right and who's wrong isn't quite possible to pinpoint, but there is certainly a chicken and egg problem here. For IT companies, their entire business model is around cheap labor. However, in the defense of employees, they are offered too little for their skill sets and they find it more valuable to use them elsewhere. Well, that's about it for today's episode. I hope you found some value in this. I'll see you in the next episode. Take care.